This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Mike back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means that you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Mike's picture saying, looking for the downloads. All right, Eric, let's start off with the equity markets. What are you thinking here?
Well, Patrick, on a technical basis, we're clearly overbought, but at the same time, I don't think there's any catalyst on the horizon, at least any immediate one, to bring on a correction. I think that's certainly possible. There's plenty of downside arguments, but I remain of the view that this is a headline-driven market and that anything is possible in either direction.
Well, Eric, let's just technically size it up. We have a primary bull trend, even if it's overbought. We had a 200-plus point pullback that basically came towards the 50-day moving average for a retest, got bought on dip, and now with NVIDIA's earnings, we're seeing a market that's attempting to break this month's high and head right back for a double-top retest of its all-time highs established back in January and February, just above the 6,100 level. Now, this is still the path of least resistance, and there's no reason at this moment to expect this to deviate from this course this week, especially now that we're past NVIDIA. But we do have a pretty important jobs numbers at the end of next week, which would be interesting to see if we find by the time our next episode comes that we retested the highs and then we're getting into that jobs numbers and maybe it causes some sort of a correction to ensue, solidifying that previous high as overhead resistance. Basically, there's room to trade the market higher, but this is not a tactical new entry for the S&P. In fact, as we approach those previous highs, the risk reward of being long the market from a trading perspective is substantially diminished. We'll watch how it plays out. I don't see any immediate reason why there should be an alarm for the downside, but after we go and test out some of these highs in the coming weeks, we'll really see whether or not that resistance marks some sort of meaningful stock market top. All right, Eric, let's touch on that dollar.
Well, we're back above 100 on the Dixie, just barely. Looks like we're going to consolidate sideways for a while here before most likely resuming the downtrend. Of course, this could be the beginning of a reversal pattern. I don't see any sign of that yet.
We went back down to the previous lows to do a key bottom retest, and we're bouncing. This is a very important level at the 100 mark in my mind, because if that was a retest of a low and establishing the bottom end of this trade range after a very ugly bear decline in the dollar, we could see a period where the dollar is just spending time consolidating, mean reverting. We could see 102, 103 on the upside. That wouldn't necessarily make me bullish the dollar, but it is so oversold that it's hard to anticipate another major leg down this early in the year. If it was September, October, and we had a multi-month consolidation, could we have another full leg down in the dollar? It's entirely plausible, just not something that I think is a high probability here in the months of May and June. And so expecting this to be far more range bound seems the most logical thing. Expecting that 99 level to probably be the lower boundary of the zone and the 102, 103 levels to be the upper boundary, and expecting like a ping pong match between support resistance, likely a very choppy dollar experience. All right, Eric, let's move on to crude oil here.
Still grinding sideways here. I don't see a directional trade on flat price. I did put a term structure trade on this week, though, buying calendar spreads, long CLZ5, short ZLM6. The argument there is that an inflection point has formed in the forward curve that it basically has put a whole bunch of contango behind the December contract and the backside of that, with a bunch of backwardation ahead of it. That can resolve either of a couple of waves. What I'm betting on is that what we'll see is the front of the curve will stay in backwardation as those first several months from December, January, February, March, as we get into the autumn months and those start to get a little bit closer, I think that those are going to move into a backwardation condition out of contango now. That's the impetus for the trade. The counter argument is we could be setting up here for a structural shift out of structural backwardation at the front of the curve into structural contango at the front of the curve, and it could be that we're seeing the beginning of a setup for that. So the trade's not without risk, but that's the only trade that I see that's opportune right now in the crude oil market.
There's no denying that there is a primary downtrend in crude oil. Persistently was making lower highs, lower lows, continues to trade below its 50-day moving average. Anyone that's trying to assess the primary trend has to acknowledge that it's still a bear decline. But we did see a direct double bottom retest of its lows. And now we're actually consolidating, where negative news is not really spurring a new wave of selling. This is a very logical place for there to be a consolidation. Now, if that ends up being the case, then the question here is, with so many people being short, so much negative sentiment, and no one having almost any interest in the oil market, is this setting up for a short squeeze? A short squeeze doesn't need to have a fundamental reason for happening. It just needs to have enough traders on the wrong side of the trade to spur a liquidity-driven short covering squeeze that can rip. The last time we had one, it was a $10+ rise in crude oil prices with no fundamental reason to doing so. So the question here is crude oil setting up for a short squeeze. That's certainly the puzzle to solve here in the weeks to come. All right, Eric, let's move on to gold here. What are your thoughts?
Well, Patrick, we just put in a lower high on the chart. The stochastics are still high, but rolled over. We're set up here to put in a new lower low, or at least retest the recent lows with a double bottom or an undercut low, or whatever your favorite outcome is. I think, though, if that doesn't hold, that previous low, 2,800 to 3,000 could easily be in play if we go towards a lower low. So I remain bullish long term. I would definitely buy the dip below 3,000 if that happens in order to add to my longs. But for now, I'm kind of bracing for a little bit of turbulence here before this is over.
Well, gold has now been in about a 6-week consolidation, and we've pretty much held the 50-day moving average and all basic fib zones. This is still a primary bull trend. And we're now trading right up along a key trend line connecting all of the previous highs that is essentially something that technical traders are going to be watching for, a breakout to see whether it's a re-resumption of trend. If we can see a breakout above this May high, it would open the window for a move up towards 36 to even 3,700 on the upside. And so we'll be watching what kind of bullish follow through that gold will be able to do, and whether this hurdle is even beat. Like you were suggesting, if that breakout doesn't happen, the natural mean reverting corrections would measure down to about 2,900 to 3,000, but I'm not actually yet in that camp, because so far the bulls remain in control. So I'm going to give the bulls the benefit of the doubt that they're going to be able to break this out, and then we'll go into a more of a correction in gold thesis if we see that there's failed rallies and then eventually a breakdown below the 50-day. All right, Eric, we got to touch on uranium here. What are your thoughts?
Well, Patrick, President Trump's executive orders on nuclear energy signed on Friday were widely anticipated. Our friends over at uraniuminsider.com had been all over it for more than a week, telling their subscribers what to expect, what was coming, and so forth. So it was really a textbook setup for a sell the news event. I was bracing myself after seeing a really nice up day on Friday in my uranium positions. I was thinking that Tuesday after the holiday was going to be a heavy down day on that sell the news event. So far, the market hasn't sold the news at all. In fact, several uranium-related issues have accelerated their rallies above their 200-day moving averages and are continuing to rally. So I say say it's game on for uranium. Now, at the same time, we're way overbought on a technical basis, so all we need is a catalyst here for a significant correction. I sure hope we get one. I'll buy that dip and add even more to my already overweight longs when we get it.
Well, it's interesting, Eric, because there's a tale of two types of charts. First of all, there's the uranium equities, which is exactly what you're referencing, which is there was an extraordinary punch to the upside where back in March and April, we were trading down, let's say on the URA, down at the $20 level. Now we see it trading at $33 just a month and a half later. Just an extraordinary rip, trading right back to the 2024 highs. And so now, can we just on pure momentum break to an all-time high? Well, that's like you're suggesting. We're way overbought going into a key overhead resistance. And typically, you would have to assume that this is going to meet some sort of distribution up along the highs and create a consolidation. Therefore, like you were suggesting, we need to wait for a tactical buy on dip opportunity to be calling new long trades for continuation, but it is definitely out of the bear market zone, and now it's just about dip buying for continuation patterns, which could easily take this to a fresh new high from the ones established last year. But when we are looking on page 6 to the Sprott Physical Uranium Trust, the physical spot prices of U308 simply have not participated with the enthusiasm of equities, and this is the more interesting part. Are we going to see ultimately the U308 prices finally participate and we have a new bull market here as well? Is this just lagging behind, or is it a sign that the equities are way overdone and they're all about to mean revert if we don't see spot prices confirming this? That's a puzzle to solve. Overall, it really, from a technical perspective, makes a whole lot more sense from asymmetry to be long the physical uranium through things like the Sprott Fund than it is to be chasing these uranium stocks until there's been some sort of a correction to reset that risk-reward proposition.
Patrick, you have a chart of the 10-year Treasury note in this week's chart deck. Walk us through it.
Well, Eric, we have the Treasury yield around 450 basis points right now. It is above its 50-day moving average, and there has been pressure on bonds on the long end. But where the real stresses are actually on page 9 on the 30-year yield. We went for a direct retest on yields to the 2023 high, just over 5%. Now, this is the puzzle to solve. Are we now reaching an overhead ceiling where these are no-brainer to own these Treasury bonds up along these highs? Or are we about to see something break in the long bond market? If we see a breakout to a fresh new high on the 30-year yield, there's going to be a point where the markets will start to care because something is not right. And this is certainly the thing to watch as to whether or not this is now going to be the ceiling, or whether or not something accelerates, causing the long bonds to maybe have some sort of a Liz Truss moment in the U.S. Now, I don't give that a high probability, but we are at a cliff's edge here on these yields, and we're going to see whether this breakout happens probably within the week.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.